Hello and welcome again to another edition of Smart Money. My name is Rangama Kata. On Smart Money, we are discussing investing on the local capital markets, mostly in shares and obviously on other securities that may be available on our local markets. Right now, it's mostly the shares, but also there are exchange traded funds which are also listed. And who knows, maybe in future I would have more things like real estate investment trusts, whether derivative instruments and fixed income instruments. But mostly our focus for now are shares of listed companies. So in the previous edition, we were talking about the income statement as one of the three key reports that you see in any financial statements. And we were saying that as an investor, you need to have an appreciation, being able to read, evaluate, and sort of analyze these statements, because this is information that is provided to investors like yourselves so that you can assess the health of the company, the health status of the company that you're investing in, and be able to make an informed decision of whether you need to go ahead investing or you need to take a different view. So today we want to talk about the second report called the balance sheet. So income statement shows you the revenue and expenses, and then finally the profitability. You earn your revenue, you incur some expenses that you pay, and you are left with some profits. A balance sheet is a bit different. So the income statement just shows you sort of a summary of an entire period. So if the results are for 6 months, it will show you the revenue for the 6 months and all the expenses for the 6 months aggregated, obviously, and the profitability for the 6 months. The balance sheet, on the other hand, shows you a snapshot, a position as at. So it could be a position as at the 30th of June. Like right now, if one is to say, okay, how much cash is in the bank? It shows you cash in the bank at that point. It doesn't tell you the cash that has been in the bank in the last 6 months. The same thing if it has to show you assets like the value of buildings. It doesn't show you the value of buildings over the 6 months or over the 12 months. It just shows you the value as at that specific period. So that is one big distinction. So it's a balance sheet for a special reason. It has to balance. Yeah, it has to balance. So you would come across a very popular kind of equation that says assets have to equal liabilities plus equity. So then just those three just tells you the makeup of your balance sheet. So usually depending on its representation, but traditionally it used to be divided into two, the left side and the right side. So the left side was where assets were recorded, and then the right you'd have the liabilities and all. So, but obviously these things they change from. I think what's critical is for you to know that a balance sheet, or now as they call it, the statement of financial position, shows the assets, the liabilities, and the equity of a business. So assets are all those things that are owned by the company. So it could be fixed assets. So those are things like property, plant, and equipment. So including the production facilities, the buildings, the land that the company might own. So those are valued depending on whatever methods of valuing that they do on specific periods, and they are shown sometimes as a gross figure or net of depreciation. And then you also have what are called current assets. So the fixed assets are sort of long-term kind of owned items. For example, if you own land, it's long-term buildings, long-term, you're going to use it for so many years. And also if you own a production plant, it's long-term, you don't use it 1 year and so it's gone. But then there are assets that are like short-term, that are called current assets. These are generated in the course of doing business. So for example, the cash. So this is the cash that is generated as you are selling or transacting or in doing whatever business you have to do. And then the other current assets, for example, your inventory, that's your stock. It could be a stock of raw materials or stock of finished and semi-finished products that you are producing, or just inventory that you are planning to sell. So that is represented as a current assets because it represents items that you own. And then I've spoken about cash, but also accounts receivables. So these are debtors. Sometimes when you are selling, we alluded in the last recording that the recording of these financial figures is done in an accrual basis. So when an income has been earned or an expense has been incurred, it's not so much about when cash is actually exchanged to hands. So there are scenarios where even on sales, you can sell for credit, and those sales are recorded as sales aggregated. So the sales figure could have cash sales and credit sales. Then the credit sales will find their way into the balance sheet as the current assets called current asset called receivables. Without boring you with so much detail, you just need to know that the assets are those things that are owned by your company. They could be long term and short term. Then you've got liabilities. So liabilities, as the term says, you're looking at the obligation that the company owes to others. You see, so the company may be owing some money to suppliers. These are represented, say, as accounts payables. So you are into a business of selling books, but you also buy those books from a manufacturer. So sometimes you get terms or credit. So you are getting these books, but you haven't paid for them. So that portion of the value of books that you haven't paid for could be your accounts payable, things, the amount that you still owe to your suppliers. Then other financial obligations like your loans, could be long term and short term. And then the last aspect is your equity. Equity, that's the portion that's owned, shareholders' funds rather. So the capital, the shareholders' funds, whether in terms of the capital that was put in the first place or whatever changes that might have taken place in the capital structure, but also it includes the retained earnings. So as you're doing your business, creating revenue and also earning some profitability, there are some profits that you may choose to declare as dividend to your shareholders. So you are paying them so that they can use the funds whichever way they want. But along the way, you also are retaining certain amounts that you are reinvesting into the business. That becomes part of your equity. So your balance sheet has to balance. Your assets have to equal your liabilities and equity. So it means if one is low, it has to be compensated by another. So you'd hear market players talking about strong balance sheet. So basically, it's something that is least geared. So you don't have so many financial obligations. Because the problem with financial obligations is you still have to meet them, even if you are not profitable or even if you're not doing so well. So it means in times that you are not performing at your very best and you have to pay back the loans that you got, it affects your overall performance and overall profitability. So that's why people always look to the balance sheet to see how strong the company is. And even also when you want to borrow, get some more loans for you to expand your finances, yes, among the other things that they look at are the balance sheet strength, to say, do you have more assets than liabilities? What happens if you are forced to pay back? Are you generating enough cash for you to be meeting current liabilities? And are you in a good shape in case there is some risk or your business faces some headwinds that will affect your revenue generation and your profitability? Does the balance sheet have the buffer? So for you as an investor, what's critical? Just look for the balance sheet strength, the level of gearing, or the level of borrowings that are there, financial leverage that is there. It's better to have a less levered business, one that doesn't have too much financial obligations. You want to have a balance sheet that has got a good mix of cash or maybe current assets and fixed assets. Fixed assets are important. They provide the bedrock on which you are running a business. So you can't be a good manufacturing business that doesn't have good manufacturing plants or factories. So that those are represented by your fixed asset. Then current assets must be there to be able to meet your current liabilities. So I think that's it at the moment. I think at some point when you start looking at ratios, you'd find that there's actually a linkage that is there between what you have on the income statement and what you have on the balance sheet. So thanks so much for watching. If you have comments, please ask. If you need some clarification, also get in touch. And I certainly hope that you become a more knowledgeable investor, so that you don't just plunge in, but you're going in there with some knowledge of okay, what's the source of information? How do you use these sources of information? Like our Facebook page, Fixing Capital, and also like our subscribe to our YouTube channel at Fixing Capital. And it's Big Smart Money, where we are helping you to invest like a pro. And thanks for watching. See you in the next recording.